Hi everyone, in this video we're going to be walking through the exercises for chapter 6 here on the practice with feedback, and we're going to look a lot at some bank reconciliations, um, the petty cash fund transactions, and let's see, anything else. Yeah, a lot of bank reconciliations is going to be the kind of primary focus, so let's dive into it. So here we've got I'm going to start on the exercise 3 tab, so I'll let you all work through the drop down problems and the matching, etc. But let's do some bank reconciliation. So here we have a problem that says as of May 31st, we have a bank statement balance. So we're going to go ahead and put that in. And we have a general ledger balance of 904. And we're going to want to reconcile these amounts, right? We're going to want to understand what is the source of the difference between these two numbers, essentially. So let's look at some of the detail here. So we can see the bank added $60 to our account for interest earned during the month. We recorded a check, but there was a mistake on the bank side. The bank deducted service charges. They collected a debt payment on our behalf. We recorded a deposit that hasn't yet showed up to the bank at the last day of the month. There's a payment in to our account of $120. We deducted $240 of checks that weren't on the bank statement. In other words, we wrote those checks, but they haven't been cashed yet by the recipients. We have a non-sufficient check, so a bounce check, an NSF, non-sufficient funds issue, and then we had an error on our side in terms of the entry that we input for a specific check. We did a journal entry essentially for 180 reduction in cash, but in reality it should have been 216. Okay, so lots of stuff going on. So let's just take it one by one. So the bank added $60 to our account for interest earned during this month. And when we go through these problems, I think it is valuable to kind of think think about where the transaction was recorded. Should it have been recorded, and how do we need to account for that to fill the gap, if you will. So the bank, correctly gave us cash for interest earned. But we didn't know that until we got our bank statement, essentially, right? So we just hadn't yet recorded that on our books. So the bank balance here includes that $60, but our books do not yet. So that's what we need to input. And again, that was interest revenue and $60. Okie doke. Then we've got the next one here. We correctly recorded a check for 262 or number 262 for $100. So the bank mistakenly deducted too much. So the bank is the one with the error or the missing, information here. And so we need to correct this problem. Here we can see error check number 262. And basically on the bank balance, it would be too low by $12. So we need to add back $12 to make it match the amount of money that went out for the on the actual bank, on our books, on our accounting side. So we add back to this bank balance, because if you think about this, the bank balance of $1260 would include a deduction for $112, but it really should have only been a deduction of $100. So they reduced the balance too much. So that's why we have to add back the $12, and that'll reconcile us back, because that's an error. And we would want to contact the bank in this instance and do whatever we need to do to actually get that, corrected on our side, or, to the actual bank account as well. Okay, so let's see here. The bank deducted $60. So again, the bank accurately deducted the money, but we didn't have that information in our accounting records until we got our bank statement. So then we can come over here. We need to reduce our book balance for a service charge. Is it $60? Yeah. Why is it not going down? Okay. Oh, sorry. We want to deduct that, right? Because the service charge is a reduction in our cash balance. Okay, the bank collected a note on our behalf. So again, the bank balance correctly, includes that cash. We need to add that amount into our cash account because it was, in our books. We're going to have to do a journal entry for these, and we're going to say, where is that? We $480 note receivable. So we'll go with note receivable $480. Okay. On 5/31, we recorded a deposit for $320. That doesn't show on the bank statement. So again, that's going to be an amount that we need to add into the bank side just because it hasn't yet showed up there, essentially, right? It will show up. We call that a deposit in transit of $320. So eventually this balance will add into the bank balance. It's already in our book balance because we recorded it, but it's just in processing still and hasn't showed up on the bank statement yet. Excuse me. Okay, on May 31st, we recorded a deposit for $320. That doesn't show on the bank statement. So we need to, sorry, that was the same one we just did. The bank statement shows an EFT funds transfer of $120 into the account. So this is, again, an increase, and we'll say EFT, so a payment to our account that was recorded by the bank, but we didn't know that the accounting needed to be done yet, or that we had a receipt until we looked at our bank statement. Basically, we deducted $240 of checks that weren't on the bank statement. So these are outstanding checks, so they are reduced here in our book balance, our accounting records, but they're still not yet cashed by the recipients of the checks. Maybe they're in the still in the mail or whatever, and so this balance of $1,260 really should be lower by $240 because at any point, at the point that those recipients get the checks, they're going to reduce that balance when they cash the checks. And we want to be careful we don't assume that we have this money in our account when we really don't. It's just a matter of the recipients of the checks going in and cashing them. Okay, the bank statement deducted $116, the amount of our customer's check, which bounced. So we've got an NSF check here, so a bounced check. So we recorded that as a receipt, which would have increased our cash balance, but they did not. It was a non-sufficient funds check, so they don't correctly do not have that amount in the bank balance, and we need to reduce that out of our cash balance because it's not really cash. The customer gave us a check, but that check was worthless, and so we need to record a receivable to continue to try and collect those funds. We'll look at that in a bit here when we do journal entries. Okay, so let's see what we got left. Okay, we made an error now where we, in our accounting records, deducted $180 for check 253, but it should have been for 216. So let's do error. Oh, whoops, sorry. Let's see, where is that going? So we deducted 180. So this amount of 904 is the result of reducing a reduction of 180, but it should have been reduced by 216 instead, because we saw that was the actual balance of the actual check amount once we got that back. And so we need to take the difference basically here and say 216 minus 180. And let's see, there we go. It's weird they both went away at the same time. So just to reiterate here what we're doing. So we accidentally did a journal entry for $180. It should have been a journal entry for 216. So we need to add, deduct more cash, $36, add that to 180 would get us to 216 to accurately reflect what that check, originally should have been written for. All right, so now, and then let's add our beginning balance plus our additions. So we end up with 1352 reconciled balance and 1352. So in essence, once we account for all these differences, there's errors, there's timing issues like these deposits in transit and outstanding checks that are just waiting to clear. We have the errors, we have some receipts of cash and service charges that the bank, had done on our behalf that we didn't know about till we got the statement. And so really our cash balance, once we account for all these differences, is 1,352. And that matches, and that's the goal between the books and the bank. All right, let's take a look at this problem here. Okay, so now we need to look at journal entries like I mentioned, and we have basically a bank reconciliation here noted above. I'm going to zoom in a little bit, see this a little better. And in our reconciliation, you can see we had on the bank side some deposits in transit, outstanding checks, corrections of some check errors, electronic funds transfer collections, note collections, so real similar to what we just saw in that last problem. So we're gonna, when it comes to doing our journal entries, just like we would have had to do here, we need to book journal entries for everything that's on the book side. Nothing on the bank side, because these reconciling items will basically just clear out themselves, or we might need, we need to contact the bank and tell them, hey, there's a mistake on this check. But these deposits in transit are just going to show up later and add to that balance. And then these outstanding checks will eventually be cashed by the recipients. And this bank balance will just turn into 1352 through over time, essentially. But these changes, we on our side need to book these adjustments. And so just to highlight, anything that's on the book balance side, we need to do a journal entry for. So with that said, like I said, very similar problem here. We've got all the items. And so we need to book all of these items that are on the book side. So we have a note collected. These are all of our additions, an EFT and interest revenue. So when you're doing journal entries from the bank reconciliation, remember that what we're talking about is cash. So there has to be cash in the journal entry, and those are all additions to cash is what we're saying up here essentially. And then we're going to do all of our credits here. So, cash is an asset, right? So debit's an increase. And then we're going to go through and reduce an accounts receivable, a note receivable, because we had that note collection there. And then we're going to record some interest revenue. And let's find interest revenue. Cool. And then remember, we're reducing a receivable. That's the EFT. Some customer owed us $25. They paid it directly to the bank. We had a note, we had loaned some money to someone and had this outstanding note receivable. We usually talk about notes payable, we take on debt, but a note receivable is us lending money ourselves. So this debt payment, the note receivable is an asset. So a credit is a decrease. So we got that reduction in note receivable related to the payment of cash directly to the bank. And then the bank, we earned money, $10 from them directly just for them having our cash essentially. So all those things increase our cash balance. And then let's do the deduction side. So when we're doing deductions, we have to start with cash, and it's just the total of the deductions, these two. And then we're going to record a service charge. So that'll be an expense. And what are we going to call that? We have a service charge account. I think we might just call that miscellaneous expense, it looks like. And we're going to say that's 50. And then we have an NSF check. These ones are a little interesting. So basically what we're saying is a customer gave us a check, right? We record that journal entry when they give us a check as an increase in cash, because checks and cash get treated, the same essentially from an accounting perspective. Because usually that's true, but in this instance, that check they gave us was actually worthless because it was a bounced check, non-sufficient funds. They didn't actually have the cash to pay us, and they gave us a worthless check. So the bank says we're not taking this check; it's worthless, and they kick it back to us. And so we thought that the customer paid us, but they actually did not, because they tricked us essentially, or accidentally did it. So what we need to do is book in a receivable. So we would have originally, either reduced a receivable when we got the check, or just originally recorded it as cash. But now we're like, this customer actually didn't pay us, so we have to follow up with them to get the payment. Hopefully we can get a hold of them somehow. But we're going to record a receivable for that amount, and we're going to try and track them down. A lot of times you get hit with a service charge from the bank too, so it's even kind of a adding insult to injury type thing when you get a bounce check type transaction. So not good. Okay, so those are our journal entries. So again, these are a lot of the items we would see off of a bank reconciliation, and then we'd have the journal entries that go along with it. And yeah, so that's kind of the whole process there. So let's keep. I'm gonna skip problem 5 because I want to keep working on bank reconciliation problems since we're already kind of on a roll with these, and I kind of want to focus in there mostly, and we'll come back to the petty cash problem at the end. Bank reconciliations are the most important part in this chapter, and I think they're an important concept in accounting in general, not just for the sake of the fact that doing bank reconciliations is important, but the idea of doing this type of reconciliation where you compare your accounting records to a source document like a bank statement, and you're able to understand the differences and reconcile and analyze those, is actually a pretty important overall kind of task in doing the accounting for a business or an organization, because that's really some of the most important work you do as an accountant or a controller, or you're really kind of controller level, is to look at all your source documents, whether that's bank statements or loan statements every month, or just all the records that underlie your accounting balances, and be sure that those balances are right. Because if they're not right, then something is going wrong with your accounting, essentially. And I see that very often with small businesses. They don't know how to do these types of reconciliations potentially, and a lot of times that leads to erroneous accounting and accounting issues. So anyway, so just to say, the overall process of what we're doing is just kind of essential as an accounting practice for more kind of like managerial, analytical type accounting work that a controller might do. And the bank reconciliation is a good example of that type of thing. So let's keep on working on these. Okay, so this one, bank statement shows $1,800 when we get it, and our book balance shows $783. So you just pull those directly in. So the bank added $90 to our account for interest earned this month. So the bank had it right. We need to add ours in. So that was for interest earned. And so where do we have? Oh, I'm right on it. Interest revenue, $90. Okay. The bank statement shows an electronic funds transfer of $405 into our account. So I'm going to say that's an EFT. Yeah. Whoop. 405. There's a note collection on our behalf. 720. The bank statement deducted $360, so the amount of our customer's check which bounced. So we thought we had the cash, but we didn't, because the customer tricked us, basically, whether knowingly or not. So we need to deduct that from this cash balance because it's included. We mistakenly deducted $351 for check 691. It correctly cleared the bank for $288. So we need to do a correction here. So it should have been a deduction of $288. In our accounting records, we reduced cash by $351. So we need to add some cash back, and that was check number 691. And we can just take the difference between those to add back. So 351 minus 288. So we need to get the 351 accidental journal entry to the correct amount of 288 means we need to increase cash by $63 to bring the deduction of 351, down, if you will, to the deduction of 288. And we do that by adding cash back through the journal entry. Okay, we correctly recorded check 752 for $315, but the bank mistakenly deducted $252. So we correctly recorded that the bank made a mistake here. So there is not a big enough deduction. So the bank balance needs to be deducted more. And we'd again do the difference just between those, 315 minus 252. So the bank balance of $1,800 needs to have $63 more taken out of it once that correction is made. The bank deducted $72, its monthly service charge. So that's something we need to record on our side. Service charge. And on 7/31, we recorded a deposit for $567 that doesn't show on the bank statement. So that's a deposit in transit. And again, this is just a timing issue. Cool. What did we miss? Okay, looks like we have one here with the errors, or the dots here that we're missing. So let's go through and make sure we got everything in here. Some sort of bank deduction. So the bank added that. We see that. We mistakenly deducted. We corrected that one. That was this 351, I believe, or that was here 691. We got that. Outstanding checks. Okay, so we deducted 675 of checks that weren't on the bank statement. So we wrote a bunch of checks that are, the cash balance here is reduced, but the bank has not yet seen those come through. Maybe the recipient just has them in there. It's in the mail or something. So we need to, in our analysis, take this amount out because we really don't have this cash. It's just waiting to be taken, checks waiting to be cashed. So that was 675. Okay, and then we just add the additions, subtract the deductions, do the same thing here. 1629. Okay, so that'll be our cash balance, after the timing happens just here, or we inform them about the error. But then to get our bank balance, our book balance to be accurate, we're going to have to book all these as journal entries, just like we did kind of in, this step 4 tab. So, so this one, again, it doesn't specifically tie to the last problem we just did, but it's the same similar process. So get these looking good there. Okay, so again, reminder, we need to book all of the journal entries on the book side for the reconciliation. We want to increase cash for the additions, and we want to decrease cash for the deductions. So that's kind of step 1 if you want to. The amount of cash we're increasing is the totals of the deductions and additions. And then we need to record kind of the individual things that are going on. Okay, so we had a check error. So we're going to need to, what are we doing? Increasing cash. So how do we want to do that? I think we would want to do, let's see. I got to think about this one. We are increasing, okay, so our error in this check, here we go. Okay, so I was like, what? We need to know a little more information. So check 959 was made to vendor company to pay them money we owed. So we made an error on our side, and this was for a vendor amount. And so let's see, we want to do miscellaneous expense, because what we're doing essentially is reducing, this was to pay them money that we owed. So accounts payable, that one's a little tricky. So the key here is that we're correcting a payment to a vendor that we owed. So remember, when we are making payments, money that we owed, that's going to be a payable. So we're correcting for that payable, because basically what we're saying is when we did our journal entry, we owed them $100, and we reduced our payable by 145 accidentally. Then the payable would be negative, and we need to credit that back to payables to get it to go to 0. So that's a little confusing. I might show an example of that in class in a T account, but key into the fact that it says money that we owed them. So that's important. If you owe somebody for a payable, you're going to pay it, etc. Interest revenue is easy. That's just a revenue transaction. We just earned some money that the bank paid us, and we know it because we get the bank statement. Service charge, again, we're just going to book that as a miscellaneous expense. Could be a service fee expense, that type of account too, if you go that route. And then, like we just talked about, accounts receivable for the bounce check, the NSF check. Okay. So reminder, all on the book side. That's kind of the process there. Okay, let's look at tab number 8. Again, we're going to continue on with the bank reconciliation problems because they are very similar. So we'll circle back to the petty cash problem. But yeah, let's just focus in on our bank reconciliation problems here. And let's start doing it. Okay, so we've got a bank statement balance of $4,200. And our general ledger shows an ending of $36.48. Okay. We deducted $420 of checks that weren't on the bank statement. These are outstanding checks. So again, those are outstanding checks. And just to note this is probably the most common type of reconciling item you see, because it's very common to have some checks outstanding for every business or organization. So that is a very realistic. Bank errors I have very rarely seen, but outstanding checks are a regular occurrence. Okay, anyway, so we correctly recorded check 752 for $240, but the bank messed up and did $252. So we need to add back this error amount, and they'll just take the difference. So 252 minus 240. Okie doke. So that's $12 add back to the bank balance to get it the correction. The bank added $60 to our account for interest earned. So that's just revenue we earned. We messed up and deducted $114 for check 675. It should have been $120, so we need to reduce that bank balance farther. And the difference between those is 120 minus 114. Okay, the bank statement deducted $120, so we have a bounced check. So we need to reduce our cash balance here by, how much was that? 120. There we go. We had a EFT incoming collection of 180. Okay, the bank deducted $30. We have a service charge. $30. On 10/31, we recorded a deposit for $240. So we have an outstanding, or a deposit in transit, I should say. So $240. So just timing issue again. A lot of times, like we said, it's the very last day of the month, so it takes a day or two to process, a deposit. Usually just one day, but okay. And then the bank collected a $300 note on our behalf. So we got some cash for a note receivable payment, and we're good to go. And then let's just add the additions minus the deductions. $4,032. All right, sweet. Rebalance there. That's great. And then another journal entry problem. Okay, and let's kind of do what we did before. So remember, everything just on the book side, and our additions are an increase to cash, and our deductions are a decrease. And the amount of cash that we're adding here is the total of all of our additions, and the total of our deductions. Okay. And then, yeah, let's see what we got here. So we had a note collection. So notes receivable went down by 280. We had an EFT, so that's an accounts receivable collection of 120. Interest revenue, $24. And then let's look at our deductions. We had a service charge, which we've just been using miscellaneous expense for. And then an NSF check, again, that's going to become a receivable. We thought we had the cash, but we didn't, so we got to follow up from them. And yeah, those are all the journal entries that we need to book to get our cash balance in our accounting records from 3648 to the 4032 that it should be, the reconciled balance. Cool. Okay. I'm going to leave this one for you all to work on. Again, just kind of drop down stuff, look through your notes in the book and all that to get the information there as far as what internal controls are being violated. And then let's just go back and look at this petty cash problem. But yeah, really focus in on the bank reconciliations here in this chapter. It's the most important thing. But yes, we have this petty cash amount. So we are going to put an amount into our petty cash from our primary cash account. So we have this kind of special petty cash, just cash that's kind of sitting off to the side, available for use as needed. And then let's see. Okay, so then we go look on the 14th and we show, okay, there's, sorry, zooming in. We have $30 left and there's receipts as followed: postage, office supplies, and miscellaneous. So we need to replenish our petty cash fund. And so we are going to take it back up to 300 essentially. And so what we're going to do is take our cash, reduce our normal cash. We're going to take it out of our bank account, and it's going back into the petty cash fund. But what we're going to debit then is for these expenses, etc. So we had postage expense, we had office supplies that we bought, we had, let's see, miscellaneous of 54. And what else are we missing? Let me put these all in. So 120, 90, 54. And what does that total up to here? What are we missing? So that's 264. And then we're going to use this kind of special account called cash short or over. So we're missing $6. So we'll have to figure that out. But that's our kind of our plug account, if you will. We just, whatever the difference is, to say, hey, we don't know where this cash went, but we're short. We don't know what the expense got done for. Somebody forgot to record what it was for or something, but it was $6. And we want to limit that as much as we can, essentially. So that's relatively small, not a big deal. But okay, on 8/15, your code, we decided to increase the petty cash fund by $180. So we're gonna bump up the petty cash by 180. So now we have 480 that should be in petty cash, at any given point, essentially. And then we're going to replenish the petty cash fund. So we are going to, again, reduce cash. We had $48 left. It should have 480 now. So the difference between 480 and 48 is 432. So we're going to put $432 back in to petty cash fund. And what we need to do is credit or reduce our normal cash account. And what was that for? We have postage again, similar types of stuff, office supplies, it's miscellaneous. And let's go ahead and put these in: 240, 192, and 12. And again, similar type thing. We need to see how much cash, what are we short by? 480. Oh gosh, It's getting bigger. $36. Oh wait, maybe are we over? 432. Oh, we had $48 left. Sorry, I messed up there. Not the difference between four. Let's see. So how much do we have? Oh, $48 left. We put the 432. And so the difference between, if you add all these up, the 240 plus 192 plus 12, you get 444 here. I'm just, if we were to add all those debits. And so we need to balance this whole thing out. I'm going to delete that. But in order to get this to balance, we need to do our cash short or over. But this time, we need to do it for a credit balance of, is that $36, I think? No. Sorry. Well, okay. 240 plus 192 plus, 444 is the total. And the difference between 432 and 444 is $12. So now we have too much cash in our drawer by $12. So we've replaced the 6 we didn't have last time. That we were missing something, and somehow there was money put back in of $6 over that original 6 that we were off. So kind of swings back and forth. Not the biggest deal in the world, but you do want to keep an eye on that and make sure it's not being abused by employees or something. This cash, plug over and short miscellaneous kind of difference that's not accounted for, reconciliation item. So that's petty cash. Again, that's just kind of how you run through that process. But as you can see by the fact that we have so many bank reconciliation problems here, that is a more pressing kind of deal. So better to understand those. And yeah, I guess we'll leave it there, and I'll let you all do the drop down problems yourself. So good luck on finishing those out, and I will see you in the next video or in class. All right, thanks everybody.